So we're always told that our economy is this perfect, well-oiled machine. But if that's really true, you have to wonder, why does it feel like it's always breaking down? That's what we're digging into today.
You know, the textbook idea is that the market is this beautiful, self-regulating thing. It's supposed to be efficient, it finds its own balance, and everything just kind of works itself out. It's a really neat and tidy picture for sure. But
The world we actually live in is full of booms, busts, and massive crises. That perfect machine seems to be constantly sputtering and failing. So you have to ask, right? Is the problem with the machine itself? To get to the bottom of that, first we've got to look at how the traditional theory explains these constant breakdowns. And usually it all comes down to something they call an external shock. Okay, so there are two key terms we really need to get our heads around here. First is exogenous, which basically means the problem came from the outside, some random event that hit an otherwise healthy system. The other is endogenous, which means the problem actually grew from the inside out, a failure that was baked into the system all along.
And here you can see that two arguments side by side. The official story is that the economy is basically a victim of these outside forces. But the other view, the systemic one we're exploring, says no. Wait a minute. The economy actually creates its own problems, making itself fragile and ready to collapse from within.
The source material really doesn't pull any punches here. It basically says that by always blaming these external shocks, the theory is playing the victim card. It's like a pilot who crashes and blames the turbulence, instead of admitting they never even checked the engine. It's a way to avoid any real accountability.
All right, so enough with the theory. How does this actually play out in the real world? Let's take a look at the three biggest economic meltdowns of this century and ask ourselves, were they really just random outside shocks, or were they failures waiting to happen?
First up, the dot-com bust of 2001. The conventional story is that tech spending just suddenly stopped. But the reality was a classic internal failure. It was a massive speculative bubble, fueled by pure hype and a ton of money being thrown at ideas that had no real long-term value.
And this is the perfect way to picture it. It wasn't some outside force that pricked the bubble. It was inflated from the inside with so much hot air and speculation that eventually it just had to pop. It was a failure from within.
Then, of course, the big one, 2008. The official story often frames it as this mysterious sudden loss of confidence. But come on, it was the totally predictable end to years of super easy credit, reckless lending, and a banking system that was taking on way too much risk.
And this Jenga tower analogy? It's absolutely spot on. The financial system had become this incredibly shaky tower. For years, they were pulling out these risky blocks, the subprime loans, from the very bottom, making the whole thing more and more unstable. The collapse wasn't a shock. It was just a matter of time. And that brings us to the disruptions after 2020. Now, obviously, a public health crisis was the trigger. That was the external event. But it didn't create the economic fragility. All it did was expose the deep weaknesses that were already there, like our incredibly brittle supply chains. And that's really the whole point. A strong chain doesn't just snap at the first sign of pressure. The pandemic was a massive stress test, and it just revealed that our economic chain was already full of weak links. The failure was systemic.
Okay, so even beyond these huge headline-grabbing crises, there are other persistent problems, kind of like glitches in the matrix, that the traditional model has a really hard time explaining. First, there's this weird thing called stagflation. The theory used to say you couldn't have high inflation and high unemployment at the same time. You had to trade one for the other. Then, boom, the 1970s happened and we got both. It was a complete paradox that the model simply couldn't handle. Then you have the rise of so-called zombie companies. Now, in an efficient market, unprofitable businesses are supposed to fail. It's harsh, but it frees up resources for new ideas. But instead, our economy is full of these zombie firms, kept alive by nothing more than cheap debt. They don't grow, they don't innovate, they just suck the life out of the economy.
And this chart, well, this one tells a story a lot of people feel in their bones. For decades, we've seen Wall Street and financial markets soar, while wages for regular people on Main Street have pretty much flatlined. If the system was really working efficiently, shouldn't that gap be a lot smaller?
And look, this isn't a new problem. The theory has always had these massive blind spots. It can't really explain the sheer devastation of the Great Depression, or Japan's lost decade of stagnation. And it really struggles to explain how the U.S. stock market can be valued at more than the entire country's economic output for years on end. That just shouldn't happen. So,
If the model we've been relying on is full of holes, if it's always blaming the victim, and it can't explain what's actually happening in the world, then where do we go from here? What's next?
Look, if there's one thing to take away from all this, it's that economic crises are more often features of the system, not bugs. They are the predictable results of these internal weaknesses that build up over time. And just recognizing that, well, that's the first huge step toward building a more realistic understanding of how our economy actually works.
And that leaves us with the big, final question, doesn't it? It's one thing to point out that the old map of the world is wrong. It's another thing entirely to draw a new one. And figuring out what that new map should look like, well, that's the real challenge ahead for all of us.